As you already know, the markets have been pulling back today. The headline culprit is tariffs. But as always, there's always more going on beneath the surface. In this short video, I want to break down what tariffs are, why they can hurt the global economy, how they impact markets, especially the tech sector, and where thoughtful investors might find opportunity in this volatility. Hello, my name is Paul Carroll. I'm the CEO and founder of Avion Wealth, an elite wealth management firm based here in Texas. Tariffs essentially are taxes on imported goods. They're designed to make foreign products more expensive and shift demand to domestic producers. Now, in theory, they protect certain industries, but in practice, they often raise costs for business, increase prices for consumers, and invite retaliation from other countries. That creates what's known as friction in global trade, which is the lifeblood of many sectors of the modern global economy. Unfortunately, this damage doesn't stop at the border. Tariffs disrupt global supply chains. They reduce business confidence and slow economic activity. Companies delay expansion, consumers pull back on spending, and exporters lose access to foreign markets. And we're already seeing some of this behavior. This is especially true in areas like manufacturing, agricultural, industrials, and increasingly technology. In fact, the tech sector is particularly vulnerable in today's pullback. They got hit hard. Many U.S. tech companies rely on global supply chains for hardware components and international markets for software and services. So you see, tariffs raise costs on imports like semiconductors. And retaliatory trade restrictions limit the ability to compete abroad. That translates to low margins, dampened growth expectations, and market pressure, despite many of these firms being fundamentally strong. And over a longer window, countries like China are doubling down on the R&D to replace those resources that otherwise they cannot get. Now, it's worth noting that while tariffs do generate some government revenue, the overall effect on public finances, contrary to a lot of public pronouncements, is negative. Let me explain why. Slower economic growth means fewer jobs created, lower wages, reduced consumer spending, and ultimately less tax revenue. Income, corporate, and payroll tax receipts typically fall faster than tariffs can make up the difference. And that's something policymakers often overlook, and it's concerning in an era when we already are running 6% deficits. So how should investors respond? I would say with discipline, not fear. Market corrections driven by news headlines can create meaningful opportunities to rebalance portfolios, especially in those sectors that have become overconcentrated after years of outperformance. This is a good moment to look at beaten down sectors like industrials or materials that may benefit from domestic investment or reshoring. To consider trimming exposure where valuations remain high, but earnings outlooks are now more fragile, such as certain high-growth tech stocks, and to reassess international diversification as currency shifts and global economic cycles present new value opportunities. We've seen international markets do rather well in the last 3 to 6 months. These are subtle shifts, not wholesale moves, but in a disciplined portfolio, they can add long-term value. So yes, the market's down today, but that's just part of the process. Tariffs may trigger volatility, but they also reveal pricing dislocations, sector shifts, and opportunities for strategic investors to rebalance and refocus. If your goals haven't changed, then your plan probably shouldn't either, because we've already taken into consideration the high valuations that were existing before this market correction. Now, if you'd like to talk through your strategy, I'm Oz here. My name is Paul Carroll with Avion Wealth. Stay calm, stay invested, and keep thinking long term. We wish you the best of investment success. Thank you.